A very good morning and welcome to the i3 webinar co-hosted with Capital Group. I'm Tech 10. I'm thrilled to have Capital Group's equity portfolio manager, Jonathan Knowles, with us this morning to share his perspectives on global equity investment strategies at this webinar entitled Investing in Global Champions. With a unique background in both immunovirology, I hope I got that right, and finance, Jonathan Knowles has some 28 years of investment experience, all with Capital Group. And earlier in his career as an equity analyst at Capital, Jonathan covered pharmaceuticals, chemicals, support services, and small cap companies. He holds an MBA from INSEAD in France and a PhD in immunovirology and a bachelor's degree in vet science from the University of Liverpool in the UK, where he was a Wellcome Foundation research scholar. And to our webinar this morning, I think it's fair to say that COVID-19 probably accelerated a number of the structural changes that were already in motion. We're talking, digital technology, disruption of, trading, supply chain, and of course, the advancement of medical technology, something I'm particularly keen to do a deeper dive given Jonathan's background. Just for admin purposes, so this will be a 40-minute fireside chat with Jonathan, where again we'll be covering a range of issues from digital, from geopolitics to investment strategies, and so on and so forth. For the audience who are joining us, welcome. Now there is a question app functionality within this app itself, so I really encourage you to send your questions through the app anytime across this webinar, and we will endeavor to answer them as much as possible. As in all webinars, there's a disclaimer here. So this webinar is for educational purposes only and does not constitute financial advice. It is intended for wholesale and institutional investors only. So to kick off, I guess, Jonathan, very intrigued by your background, the intersection between finance and medical in a sense. So look, there's all this talk about COVID-19, vaccines and therapeutics, and there's a difference there. There's all these commentaries about different drug companies in different phases, phase 1, 2, 3, 4. Obviously, we see President Donald Trump, if you like, miraculous recovery or very speedy recovery. So I guess maybe as a start, you give us a sense of what's happening in the world of medicine, vaccines, and again, try not to get too much into the macro piece. What does it mean again, from an investment perspective? Jonathan?
Thank you very much, Tech, and good morning, everybody in Australia. Very nice to talk to you. Can you hear me, Tech? Okay.
Yes, all good. All good.
Good. Perfect. I'm quite encouraged by the progress so far in COVID. I remind people that we've had a number of viruses really cured in the last, or pretty much conquered in the last 20, 30 years. HIV that emerged in the mid-80s, that is a very, very treatable disease today. Human papillomavirus, which causes cervical cancer and genital warts. There's a vaccine for that. That was actually discovered, the technology for that actually came from Australia. Hepatitis C, this is a terrible disease. It affects hundreds of millions of people. In the last few years, we've had a cure for that. Ebola virus, there's a drug now for treating Ebola virus, which is a very, very lethal viral infection. Respiratory syncytial virus, which is a condition of premature babies. There's a fantastic drug for treating that. And all these innovations have come in the last 20 years. So I think we are pretty good at, we're getting better at treating viruses. And I think we will get on top of COVID in due course. I'm quite hopeful. The first piece of data that came out, and you probably noticed that mortality rates have dropped from COVID quite a lot with the second wave that's happening in Europe. And the prevalence is much higher. In other words, many more people have got the virus, but the number of deaths is much, much lower. And I think in part that is this use of this dexamethasone, which is a steroid. And there was a big trial in the UK. They showed it worked, and now it's being used globally. It's a very cheap drug, but that seems to help in certain forms of, in a form of COVID where people get their immune system overreacts, and just simply giving them steroids seems to give a much improved survival. The other treatment that I think is very encouraging and looks very exciting will be monoclonal antibodies. And these are basically synthetic antibodies that are made in the lab that target COVID, and you can make them to target anything you want. Several of the best-selling drugs in the world are now monoclonal antibodies, and you can make them to all sorts of targets, including viruses. And Regeneron, which is the one that we used, their one was used in Donald Trump, and it's a dual antibody. It acts on two different bits of the COVID virus, and the data there look pretty good. Again, in a subset of COVID patients, the data look very, very good. And my guess is it's going to be pretty. I mean, it's a guess at this stage, but I think it'll be pretty widely used. One problem will be, or one potential problem might be manufacturing capacity. The COVID drug is, each shot is 8 grams, which is quite a lot of protein. But fortuitously, or I don't know if it's really fortuitously, but Samsung Biologics, Samsung in Korea, have built this enormous plant, which is currently, well, I think GlaxoSmithKline have taken an option on it. But that option, I think the first company that has a really good therapeutic with really robust data will get to use that plant, and it's huge. So, we do actually have a massive plant available in the world, and so I think actually they could produce this drug pretty quickly in pretty big quantities, if required. So I think we're getting there. Then you have all the vaccines that are coming. There's multiple vaccines.
Yeah.
I read yesterday Johnson & Johnson have already made 100 million doses of their vaccine in Belgium, and they don't even have the results yet. But that shows you how, if it doesn't work, they'll obviously have to destroy the 100 million they produced so far, and probably the next 100 million they produce before they have that data. But that shows you how the drug companies are really stepping up and trying to help you. And so if the data is good, you won't have a 3-month lag while they make it. They'll already send out hundreds of millions of doses. So no, it's impressive. It's impressive what's going on.
Yeah, I think you mentioned Johnson & Johnson, and I've seen various commentaries on, again, various names that's been sort of thrown out where Johnson & Johnson is in phase 3. I think in Australia we're familiar with the AstraZeneca Oxford trials, which were affiliated, and they are sort of in phase 3. There are others like CSL in Australia, that's phase 1. So various drug companies in phase 1, phase 2, phase 3. You've given us a big overview, not just COVID, but sort of broadly antivirals been around. If I could draw you into, I guess, the investment opportunity, I mean, is it, do we take a thematic into medical? Is that where it is, or you think, look, this will come and go, it's a fair, what are your thoughts on that?
Well, my guess is the drug companies are going to be reasonably well behaved here, and they're not going to try and make a lot of money out of COVID. I think they'll do this almost pro bono. And I mean, look at what Johnson & Johnson are doing. They're taking enormous risk, making 100 million doses, but they clearly think it's the right thing to do. And I don't know, maybe governments have said, well, we'll pay you even if it doesn't work. But I don't think I don't think any of the companies are going to try and make a huge amount of money here. I think the way to make money will be, if you believe that we're going to get on top of this, would be to buy some of the recovery stocks, the beneficiaries. So there's all sorts of ways of investing in COVID recovery that I think would be better drug stocks if we have a drug. Yeah.
It's a good way to look at it. I guess you've looked at how impacts of obviously what's happening now and supply chain and how companies are operating. And it's a nice segue to, I guess, my next question around supply chain. There's this talk about de-globalisation of supply chain. Again, most will agree this is not something that just happened. It's been around for a bit. So I'm keen to get your views on, when you talk about de-globalisation, what does that mean in terms of your approach to companies? I mean, in the past we talk about emerging and developed markets. Maybe there's no such thing. There's obviously the whole trade tensions out there. How does that play out into the way you look at how companies will operate?
Well, we're definitely seeing a sort of carving up of the global supply chain. So, for example, we saw a German company that makes these very advanced ovens, and it's a very, very good business. And they told us that it turned out one of their suppliers was reliant on a certain component from China, and it was 100% reliant. And they have now made sure that everything in their supply chain is dual sourced. They're not relying just on China. And I think you're going to see that. We're seeing that at a lot of companies. So I think where companies are 100% reliant on China, they're not. I think a lot of them are not going to let that situation prevail. So I think it's a gradual transition. Certainly in antibiotics, I think some of the antibiotic intermediates, the world has become completely reliant on China. And now talking to some of the Indian pharmaceutical companies, it's pretty clear they're now being asked to produce some of these intermediates. So I think they'll still source them from China, but I think you'll see dual sourcing.
Right.
So you're definitely seeing that happening in the supply chain. There's a lot of tension between India and China as well. So it's interesting. It's not just America that's putting up barriers here. The Indians are putting up quite a few barriers to China. They've they banned they don't like Chinese mobile phones anymore.
TikTok as well.
They've asked Samsung to come in. Well, yeah, TikTok is TikTok. Well, India. Interesting. India wants its own internet champion, and I think they'll have a sort of partial champion in Reliance Industries, which is this enormous industrial conglomerate in India, which has built a very good mobile phone network. It's got an internet, a fiber network, and they're now doing deals with the big US internet companies to work with them.
Yeah. I sort of want to bring you in, and I know that, for example, on your end, you invest, I guess, globally, but a number of investors say in Australia, we look at emerging versus developed markets. And a while back, when we think emerging, again, trying to define an emerging market company may not be that simple. Is this a company that sources revenue primarily from emerging markets, or is it based in those emerging markets, and so on and so forth? So many definitions there. I'm just wondering, given the current outlook of what's happening in China, India, and so on, how should we be looking at companies, so-called, or opportunities in the so-called emerging markets, given the current scenario?
Well, I always think China and India are the most interesting emerging markets because they're very big markets. You can have scalable businesses in them. They're different markets, but I always think those are the two most interesting emerging markets. What's interesting is both of them, I think, are doing reasonably well, given COVID. China, air travel is almost back to normal. Shopping is back to normal. There's relatively little COVID in China, and luxury goods sales, for example, are booming in China. Everyone is, people can't spend so much on a vacation, so they're going and buying themselves a Louis Vuitton handbag. So China is booming. India is, interestingly, looking at some of the bank data from the last, from the biggest private sector bank, HDFC Bank, there, it's almost back to normal. Lending growth was reasonably strong in the last few weeks, and I think what's happened in India is it's a very young population. The average age is 25, 26. So I think they haven't been as badly hit by COVID as, say, a very mature, developed economy like the UK or France, where the average age is much higher, and COVID is much more of a threat. And I think also they simply haven't been able to afford to, they had this big lockdown, but they simply, people had to eat, so they had to go back to work. So I think a lot of them have had COVID and have moved on. And the young, as we all know, are not that badly hit by COVID. Some are, but the vast majority are not. The surveys showing that in some of the sort of poor areas of Mumbai, that 60% of people have COVID antibodies. So it's been and gone. So arguably those countries are, on their way back already.
Again, if I could say the China story again, in view of supply chain and talk about the German company and others sort of moving partially manufacturing out of China. Am I right to say that the Chinese story is a consumption story that you look at? It's a local consumption story.
I think some of the most interesting stocks, are consumption stocks. The Chinese, like everywhere else in the world, the government is stimulating the economy, but they're still a saving nation. They still run the current account surplus isn't what it was, but it's they're still running a surplus. And some of the best stocks have been consumption stocks. Yes, so I wouldn't disagree with that. I think technology is also it's hard to sometimes distinguish between consumption stocks and technology stocks now. But Alibaba has obviously been a very good stock. Payments, payments been very good in China. I think this this Ant Financial business is a remarkable business. It's going to be spun out of Alibaba. Some of the consumer stocks, have been very, very good as well in China, as you point out. Online food delivery has been good. It's consumption, I guess.
Yeah. Look, I've got a bunch of questions relating to technology, which I'll jump into in a moment. But again, just a reminder, we're sort of halfway to our audience. If you've got questions, please feel free to enter them via the question app, and we'll try to answer them. So Jonathan, back on the issue on, the word that's been thrown around a lot is disruption and digital technology. Maybe I could have you start, you're thinking about when you see what's changing, obviously pre-COVID and into now, digital economy, disruption. How do you unpack the issues? How do you see what's happening? And obviously, where the opportunity set is in terms of how you think about your portfolio construction?
Well, there's multiple questions there.
It's a big. I'll start at the big high level.
I generally run very low turnover. My turnover is around 10%, and so I don't usually change a lot suddenly. I went into this crisis, fortuitously holding the right stocks. My top 5 holdings were Amazon, Microsoft, Shopify, MasterCard, and Adobe. And I've only added 2 or 3 holdings in the last 12 months, so I haven't changed a lot. I think, obviously, as we all know, what has really happened is we've gone forward. We've probably done 3-4 years in 1 year of progression. Look at us now. We're meeting on sort of video conference call. This was undoable really 5 years ago. We've all learned to I can't remember when I last used cash. You know, we've all learned that's all changed really in the last year. So we've all been forced to change our behaviour. I think the question none of us are quite sure about is what happens next. Even if we get on top of COVID, which I think we will, my guess is there'll be some dramatic changes in people's work patterns now. So, you know, I think we'll use offices, but we'll use them for entertaining clients, and we'll use them for educating ourselves, for training our youngsters and training ourselves. But, you know, I guess we're all going to work from home more. So that'll affect real estate, commuting, restaurants. You know, there's going to be quite a lot of change. I mean, it's hard to be 100% sure, but I don't think we're going to go straight back to how we were before. You know, I think that's unlikely. So hopefully that sort of answered your question a little.
Yeah, maybe if you don't mind, I'll throw another cliche to you. There's this phrase that says every company is a tech company, and do you agree with that? Every company is a technology company nowadays.
Well, I think you have to be to a degree. Yes, I mean you know, IT. I mean, even in our business, IT is probably our biggest expense. You know, we all need you know, software to keep going, and you know, look at all this conferencing software we've just introduced. That's another new thing we're all going to subscribe to. So no, I do think that's the case. It doesn't mean that, you know, I think there's still some superbly attractive some non-tech companies. You know, it's an American paint company, and they sell paint to the trade, mostly to the trade, you know, to trade painters. And it's a superb business. It's got, you know, it grows its top line, you know, almost every year. They've got pretty high margins. They generate a lot of cash, high return on capital, and they buy back shares. You know, so it doesn't. That's not a particularly sexy industry, but it's a very good stock and a very good business. And I suspect, in a way, it's less likely to go obsolete than some of the tech companies we own. You know, I think we'll still be painting our walls in 20 years' time. I'm not sure what technology we'll be using in 20 years' time. Yeah.
Yeah. If I can segue into, I guess, one of the broader, so under the broader digital economy topics is 5G or the quest for 5G leadership. Now, I know we covered a bit on geopolitics or trade tensions earlier, but I'm trying to frame, I guess, the understanding around 5G, where, yes, at a very high level, you've got trade tensions, you've got the US-China thing, which we're familiar at a very macro level. And we think of 5G, I understand, so China is leading the race. They are starting to implement already. But at the core of 5G networks is semiconductors, of which US and maybe Taiwan, you've got TSMC there, that is leading the race there. So there is that tension, and again, wondering how you see that playing out, and obviously what the investment implications are in terms of stocks in the area.
I'm not an expert on semiconductors, nor am I an expert on so US-China trade tensions. But my understanding is, you know, China is substantially ahead, so 2, 3, 4 years ahead, and the US is keen to slow that down, because I think there's some worry that the first guy into 5G, there could be lots of spin-off benefits from 5G, and they'll be the best position to benefit from all those because they'll be the first there. So the US, I think, would like to slow down China, and you know, one way to slow it down is to slow down their access to semiconductors. I think that's exactly what they're doing. And you know, companies are being told that you can't sell to China. So I think ASML has been told, this is the Dutch maker of these extraordinary lithography devices, I think they've been told not to sell to China. You know, each one of their machines is about, I don't know, 150, $200 million. You know, these are extraordinary bits of kit. So yeah, I think the US is definitely clamping down on Chinese access to semiconductors. But the benefit, I mean, what's so interesting about the semiconductor supply chain is how concentrated it is. You know, these are very rough figures, but you know, 90% of lithography machines now are made by ASML, and they've only really got three major customers that can afford their equipment: Samsung, TSMC, and Intel. And you know, arguably Intel is arguably TSMC is pulling ahead. So you know, maybe it won't even be three in the future. So it's a very, very narrow supply chain. You don't have much choice where you go. Yeah.
Right. We've covered, I guess, various questions around. You know, we talked about digital economy, innovation in healthcare early on, supply chain disintegration. In fact, before I get into the next questions, which is around portfolio construction, I have a question from the audience. This, in fact, relates to COVID. So, your thoughts on how and when Europe will come out of the current second wave of COVID, and the impact, if any, on global markets?
Cool. Very good question. Well, we're going into the tough period now because you know it's winter here in the northern hemisphere, and you were going to see a lot of COVID because people are. One method of transmission is obviously airborne, and people will be inside, and we will see more transmission. And I think we're just going to struggle through this winter. I think there's going to be surges. Governments are going to clamp down. The surges will come off, and there'll be more surges. And you know, I think we're just going to battle through the winter. What are governments going to do? I mean, I think they're going to do more of what they're doing, which is basically printing money and you know, spraying the money around. You know, to try to keep the economy going. I heard a remarkable figure the other day from a banker at Barclays. I mean, you know, it's just I was talking to a banker at Barclays, and he told me that they'd lent more in the last 4 months than they've lent in the previous 10 years. Wow. And this is all effectively guaranteed by the government. So it's not. I mean, obviously, Barclays will, if somebody goes bust, Barclays will have to presumably go through the procedures to recover the money. But if the money is not recoverable, you know, I think the government will stand behind it. So, what does it mean for markets? Well, you know, printing money is generally good for markets. It props them up, but I'm not sure it's good for long-term growth, because the more debt you have on government balance sheets, that you know, all the evidence is the more indebted governments get, the lower growth is, and I think long-term growth will be very low, and it's very deflationary as well. So, for markets, my guess is we're in for a long low growth period, low inflation, and if you can find growth stocks, they'll probably be quite valuable because you know, growth won't be easy to find. Hopefully that answers the question. Yeah.
Thank you. I think that's a nice segue, because my next question was around investment approaches or investment styles. Now I know you are style agnostic, but often in the market we talk about growth versus value investing. I saw, I think, a recent paper by you or your colleagues around defensive investing, and I thought it looked, when you talk about defensive investing, it looked fairly similar to value investing. I mean, you talk about classic defensive sectors like utilities, healthcare, consumer staples, and so on. But yet, I suspect there are nuances between the two. Would you care to elaborate on that?
Sorry, so well, I mean, the great thing about capitalism is it destroys businesses and changes things all the time. So what you used to think was defensive may no longer be defensive. And you look at, say, the advertising agencies, and 15 years ago we thought of them as almost inviolable franchises, and Google and Facebook came along and basically sort of semi-dismantled their businesses. So I think I think one of the criteria you need to be in financial markets is paranoia, and you always need to be challenging your assumptions and saying, is this business still robust? I mean, you mentioned 2 or 3 business industries you thought were defensive or might be defensive. They're utilities, consumer
staples,
consumer staples. I would argue that to a degree, consumer staples hasn't been that. I mean, ask Warren Buffett about his investments in Heinz, and that hasn't. Some of them have been pretty tough. Amazon has destroyed, or not destroyed, but transformed certain businesses I would have thought were very stable, say like Duracell batteries or something. They've really been up against it with the Amazon batteries, which are so it's not entirely clear to me that what was safe is still safe. So I think on the other hand, I'd say paint is still a certain of those businesses are still pretty safe. So I think you just need to be paranoid about and be willing to change your mind, because capitalism has a habit of eating businesses, changing business models.
And to my earlier comment about this discussion out in industry around value versus growth, or is value dead, is value coming back? Those sort of discussions, is that meaningful?
Well, it's look, every financial show loves this value versus growth debate. I think every it's very popular amongst pension consultants. Publications like Morningstar use it. So it's a framework. It's something we're all conditioned to think about. But I sometimes wonder what really is value. I quite like, again, the Warren Buffett's adage, which is buy a great business at a reasonable price rather than an average business at a cheap price. And and I've tried to, that's always been kind of my the way I've approached it. So I won't just buy a business because it's on a low valuation. It's got to have decent return on capital metrics, I think, for me to buy it. But obviously, if I can get a great business at a reasonable price, I'm going to do it. I think the thing we're all struggling with is growth is much more, decent growth companies are much more expensive than they used to. 2009, 2010, you could buy really good growth companies on 12, 14 times earnings, and they were growing 10, 12%. You're buying them on 1 times growth. Those same companies now are on 28, 30 times earnings. They've re-rated. So, but that's because interest, 10-year bond yields are so low.
Sure. So in the scheme of things, they are not considered expensive.
I think a more relevant, a more the key question is, what do you think bond yields are going to be? What do you think the price of money is? And you know, if you think 10-year bond yields are going up, then you know the multiples on growth stocks will come down, no doubt in my mind. Now, if 10-year bond yields go up a little bit, you know, multiples will come down a few turns, and you know, the stocks won't do anything for a year or two. But you know, if 10-year bond, you know, if inflation comes back, then you probably don't want to be in high PE growth stocks. So that's, I think, the call you need to think about. Yeah.
And the reason I don't
think that's going to happen, Tech, but for the time being.
Yes, and I think inflation is not. So I was going to say early on, you mentioned that your top 5 holdings, you had Amazon in there, and obviously people talk about Amazon being a growth company, it's disrupted others. I guess for those reasons, you continue to hold on to Amazon.
Yeah, I still own my. I mean, I've owned it for over a decade. I can't remember exactly when I bought it now, but I've owned it for a long time. Yeah. You know, I still like the two main businesses there, the cloud business and the retail business. Yeah.
Sure. Look, I think with the last few minutes, I thought in closing, we've covered various themes. I mean, we talked about digital technology, healthcare, supply chain disintegration, a bit of geopolitics, and we've covered, I guess, the last few minutes on approaches. So if I try to wrap this all up, I mean, moving forward, I mean, the next, who knows, 3 years, 5 years, 10 years, I know we're long-term investors. What are your thoughts? You know, what are you interested in? How do you see, you know, the world, if you like, moving? But more importantly, how does that translate to your ideas for the portfolio that you're managing? What are you keen? What are you looking at?
Well, I go sector by sector, by stock, and I run very concentrated portfolios, so I don't have to find too many stocks. And I think I told you I've only added 2 or 3 in the last 12 months. So you know, I need to find. You know, I like to. That's about the rate I operate at, and I'm not changing that much. I think one area I'm very, very interested in is, I think there's going to be a paradigm shift in diabetes treatment, and we're going to go. You know, in the old days, diabetics would test their blood sugar by putting a little prick in their thumb, and they'd take a little bit of blood, put it in a test kit, and then work out how much insulin to give themselves, and they'd probably slip out just before a meal and inject themselves in the bathroom and come back. I think you know, the days of that happening are numbered, and I think over the next 10 years we will see a shift to what's called continuous glucose monitoring. So these are a little patch on your arm which you stick on. It lasts about 2 weeks, and it measures the concentration of sugar in what's called the interstitial space, and it transmits that knowledge to a telephone, your mobile phone, and then your mobile phone will communicate with a pod which is attached to your abdomen, and that pod will administer the correct amount of insulin, and it'll adjust it up and down depending on where your sugar is. And I think you're going to get much, much better control of diabetes. And diabetes is an enormous cost to the healthcare system. You know, it's the main cause of amputation, renal disease. It's a big cause of heart disease, big cause of blindness, impotence. A huge number of things that diabetes is associated with, and a huge number of people have diabetes. And I think this technology, it will first move into type 1 diabetes, and then gradually morph into quite a few of the type 2 diabetics as well. And the type 2 is the huge market. So that, I think, will be. I own several investments in that space because I think we're going to see a massive shift in that space. So that's one example of something that I think is you know, very, very interesting. There's a company in America. They're the world leader in laboratories in laboratory equipment and laboratory consumables for veterinary surgeries. And they provide vets with these little diagnostic sort of cartridges that you put into their machine, and you can run a diagnosis on, you know, for, I don't know, whatever particular disease, or you can do a health check. There's a company in America. They're the largest animal drug company in the world. You know, they've got a really interesting franchise in sort of dogs with you know, bad skins and chronically bad skins, and this is a really common problem. And that's, I think they're selling around. They've got 2 drugs which are kind of leading the way there. They're selling around $800 million of those 2 drugs, and it's growing 20% a year. I mean, you know, they're going to have $1 billion dog skin franchise. You know? Very, very, very profitable.
Yeah.
And there's no government intervention. You know, this is a cash market. You know, if you have a dog, you got to insure it. If you want to, you know, you can't go to the government. You know, you're not negotiating with the government. You know, grows. You know, these are the kinds of sort of niches I try to invest in, where and it gives me a little bit of gives me some diversification. It's not just a technology portfolio. You know, these are. Yeah. And interestingly, one implication of COVID, by the way, is dog ownership has rocketed this year. The price of puppies has gone up dramatically. Everybody in COVID has taken on a puppy. So we have 10 to 15 years now of higher dog ownership because of all these puppies that have been taken on. So you know, I mean, you know, veterinary surgeries are, frankly, I think they're struggling to cope with the workload under COVID because of social distancing. You know, they're really working hard, those vets. No, it's a good little industry.
There you go, fascinating. I'm afraid our time is up, but thank you very much. It's been fascinating ideas. We started this webinar talking about, you know, implications of COVID and drugs and so on. And I guess our conclusion is like, well, we're not so sure whether there are opportunities there, but, you know, maybe opportunities elsewhere, other types of drugs. You mentioned diabetes and maybe investing in a puppy company or something like that. So I hope for our audience, this has been fascinating. We've bounced around looking at various ideas, and we've broadly themed this as global champions. So thinking beyond, I guess, traditional sectors. And hopefully, Jonathan, thank you very much again for your time. You've shared with us some of your ideas in stocks and trends and so on. And we hope to have you again next time. Everyone else, thank you very much and have a great day.
Thank you very much, and thank you for listening. Thank you. Take care. Thanks. Bye.
Bye.